Hi, welcome to 4.04, the Stock Market 1. This is a continuation, and we are starting on slide, should be 23. Investment goals. What are the goals of a typical shareholder? As a whole, stockholders generally pursue two goals. One goal is to secure a steady income that will grow. Another goal is to obtain high potential earnings from the investment. Some investors focus on just one goal. Others pursue both goals simultaneously. Many investors choose some stocks with the goal of producing high growth in the short term, and they also own stocks they hope will produce a steady income that will grow over the longer term. Value stocks and growth stocks. The main decision that most investors have to make is between safe stocks and riskier stocks. This choice is often categorized as value stocks versus growth stock. Value stock is a relatively safe investment, while growth stock is generally riskier. Companies that issue value stocks are usually large, well-established companies that offer well-known products or services. These companies usually own many valuable assets, are reliably profitable, and typically pay out regular dividends. The stock price may be low relative to the value of the company, but it is usually not subject to high volatility. In general, investors attracted to value stocks seek security and a steady dividend. They want an income stream that will be reliable and grow steadily over time. Growth stocks are usually smaller companies. They typically do not have large assets or a proven financial history. They may be profitable or merely looking forward to future profits. The stock price is likely to be high relative to the proven value of the company, and the price may be subject to high volatility, but the potential return is also high. Investors attracted to growth stocks are generally willing to take a higher risk to achieve a higher return in a smaller amount of time. They accept that the company will not pay dividends since it is growing and needs to reinvest profits. Investors in growth stocks focus on potential for capital gain. They are interested in buying low and selling high. Some investors have more than one investment goal, so they have a mix of different types of investments in their portfolio. Some of the investments will be lower risk value stocks, and some will be higher risk growth stocks. Socially responsible investing. Investors have to be smart and calculating when choosing investments, and they need to focus on economic variables. Still, they can also find ways to invest with their hearts. The term socially responsible investing refers to the choice some investors make to invest in companies they believe are ethical and whose business model and mission they can support. Every investor has a personal preference. Some investors steer clear of companies they consider unethical, even if the stock performs in a way that satisfies their investment goals. Analyzing price fluctuations. It is best to buy low and sell high. That is how investors make a profit. But, of course, it is extremely difficult to know exactly when to buy and sell. How does an investor know when a stock price has bottomed out or reached its peak? It is crucial to keep a close eye on the price movement of stocks to make big decisions about buying and selling. Smart investors try to avoid making quick decisions. The stock's performance over the long run says much more about where the price is headed than its short-term performance. Analysts study two main sets of factors to understand stock price movement: business fundamentals, the traits of companies and the general economic conditions that surround them, and market trends. Analysis that focuses on business fundamentals is called fundamental analysis. Analysis that focuses on market trends is called technical analysis. Fundamental analysis. Fundamental analysis looks at the company, as well as the overall economy, to figure out how the company's stocks will do. Fundamental analysis traditionally ignores what is happening in the stock market itself. From the perspective of a fundamental analyst, if a company's stock price goes up or down, it chiefly reflects the economic health of the company and of the economy, not a trend among investors and stockbrokers. In essence, fundamental analysts study the basic financial attributes of a company, including facts from the company's balance sheet, which reveals its assets, liabilities, and net worth; financial statements, which contain figures such as revenue, net income, and earnings per share; cash flow statements, which record the amount of cash entering and leaving the company, auditors' reports, and SEC reports to make sure all the financial data has been reviewed and verified. The overall economic conditions in which the company operates, such as interest rates, GNP, which is the gross national product, inflation, and unemployment. Examining this data gives fundamental analysts a clear picture of the most important aspects of a country's present and future financial prospects. Technical analysis. Technical analysis takes a different approach to understanding stock prices. Technical analysts do not examine the company's basic traits or the health of the economy. Instead, they focus on short-term movements of prices in the stock market. In other words, technical analysts look at the investor behavior to guess what decisions they'll make next. Technical analysts use charts, tools, and equations to understand recent market activity, but mostly they rely on an analysis of supply and demand. If the demand to buy a stock exceeds the available supply, the stock's price will rise. If there are more people who want to sell than those who want to buy, supply exceeds demand and the stock's price will fall. If trading volume is high when a price moves up or down, it is considered to be a stronger indicator of where things are headed than if the trading volume is low. Similarly, if prices rise or fall by a large margin from recent prices, the trend is considered more significant. Fundamental versus technical analysis. Why choose one form of analysis over the other? There are dozens of factors to consider when trying to understand and predict changes in stock prices. Even though fundamental analysis and technical analysis focus on different sets of factors to understand and predict price movement, both approaches can be successful. Whether an investor chooses to focus on economic conditions, market trends, or a company's financial statements, they will get good insight into what prices will do. Take a look at two examples to see the benefit of using different types of analysis. Say you have a value stock in a large company with many assets. The stock price has been declining recently. The company reported a dip in revenues in the last quarter, but the longer-term trend for revenues showed slow, steady growth. Knowing this, you probably have a pretty good understanding of why the stock price dipped recently, the short-term drop in revenues. So there is no urgent reason to sell the stock. It is reasonable to wait to see if the company's revenues rise again next quarter as the long-term trend indicates. Here's another example. A new company just started listing on the stock exchange. It has yet to make a profit and its financial record is minimal, but many investors think it is a great growth stock. The company is in a rapidly growing industry. How can you judge where this one is going without getting into technical analysis? It makes sense to look at recent market trends in that industry. What has happened with other new companies in that industry that recently listed? Bulls and bears. You have seen that many factors influence stock prices. The factors can be grouped into two broad categories: business fundamentals and market activity. Despite the hopes of all investors to succeed by entering the stock market, the overall conditions of the market can be good or bad. A bull market occurs when the market goes up over a period of time. Bull markets tend to develop when the economy is strong, but the psychological state of investors can also affect the market. Bull investors have faith that the upward trend in stock prices will continue. They tend to buy more stock, which keeps the market growing. A bear market describes a market that appears to be in a long-term decline. Bear markets tend to develop when the economy enters a recession and unemployment is high. Bear investors lose faith in the market as a whole, which reduces the demand for stocks. Like bubbles, bull markets can't last forever. Eventually, a bear market will emerge, in which there's pervasive pessimism, lagging investor confidence, and general expectations that stock prices are headed downward. Usually, the market cycles between bull and bear markets as bull and bear investors cancel each other out, and the market corrects itself. Capturing stock prices. There are two main types of stock exchanges: live auction markets and virtual over-the-counter markets. There are also two main types of brokers to help investors trade stocks: full-service brokers and discount brokers. People have different investment goals. Investors who want a steady income over a long period will be attracted to value stocks, while investors who want high earnings in a short time will be attracted to growth stocks. Some investors engage in socially responsible investing, choosing stocks for ethical reasons. There are many factors that can influence stock prices. Fundamental analysis focuses on a company's traits and on economic conditions, while technical analysis focuses on recent market activity and trends. Finally, there are traits that characterize individual investors as either bulls or bears. All in all, market psychology has an important effect on behavior in the stock market. And that is the end of 4.04, the Stock Market 1. Let me know if you have any questions or concerns. Have a great day, everybody.